start going down to 80% this year, which is something that, you know, all of us have been waiting on. But we want to know what that means and how's that actually going to affect us in terms of investments, in terms of our tax savings. So let me just see here if I have a presentation somewhere stored on my drive. Again, apologize. I probably should have had this going before. But before we get started, just for those of you who are here live, if you can do me a favor and just open up the chat, let me know. I would love to know if this is, you know, what your experience with cost segregation is in terms of your knowledge. Is this the first time you're hearing of it? Is this something you've heard of before? Have you used it personally? Just good, always good to know where we are in terms of the, you know, how basic we should go, how advanced we should go on this topic. All right, awesome. Well, first time hearing of it. Okay, so yeah, I think for a lot of people, and it's pretty fascinating. When I first got started in cost segregation about 5 years ago, I asked every single person that I knew who was a real estate investor or broker or anyone that had anything to do with real estate, and I asked them, you know, what do you know about cost segregation? And the answers that I got were actually fascinating. It was completely polar opposites. It was either yes, of course, we use cost segregation on all our properties. It's a great tax strategy. And the opposite end was everyone else basically, and that was a small portion. And everyone else basically said, I've never heard of this before. And so there was no middle ground. There wasn't even people that had heard of it and never really knew much about it. Over the past years, it's gotten obviously a lot more education has been out there. There's been a lot more talks about it, but we're, you know, I've been a guest on over 400 podcasts at this point, and just, you know, trying to spread the word, not myself alone, but this has been something that has been kind of passion project for me over the past 5 years, to just kind of spread the word as much as possible. And I'm having trouble finding another version. Actually, give me 1 second. I think I have one in my Google. Let's check in my OneDrive. I got so many online cloud services over here. You don't know which to check. You know, someone's got to make some sort of. I have one in my Google Drive probably. Bear with me. Appreciate it, guys. Here we go. Let's see. Okay, I found one. So now I just gotta download it and we will be good. All right, let's do this. Now I can probably just open it here. I can just open it here and share from this from Google Drive. Here we go. So sharing my screen now, guys. Thank you for bearing with me. And I'm actually working on getting an updated one. So it's more into, we got the updated version for the 80% bonus depreciation. But in the meantime, we'll slides, present. How do we present this now? There we go. All right, the magical world of cost segregation. You guys can see this, right? All right, perfect. So yeah. Let's just jump right in here. And please, I'm going to try to keep this as basic as we can, get into the nitty-gritty of it as well. But I want to make sure that all our questions get answered. So if I don't cover something, please put it in the chat, and we'll make sure to cover that. So yeah, my name is Yonah Weiss. I work for a company, the biggest national cost segregation company called Madison Specs, part of a larger group of companies, Madison Commercial Real Estate Services. And we're going to jump into understanding what cost segregation, what depreciation is, because to understand cost segregation, you have to know what depreciation is, what's bonus depreciation, who should be doing this, when you should be doing it, and what's a real estate professional. This is probably the most important topic because, and for those of you who are here live, and I understand people are going to be watching this later, this is probably the most important slide we're going to get to, is what is a real estate professional. If you guys here who are watching this live, and keep put in the chat, if you are first full-time real estate professional, you'll just put that in the chat, like full-time, and that would be great to know. If not, you would know, not full-time, but that is really important. You'll see why shortly. So that can include being a broker, a property manager, et cetera. So let's talk about depreciation. depreciation sounds negative, right? It sounds like something's going down in value. And in fact, that's what the tax deduction is based on. It's based on this principle that property or things go down in value as time goes on. But depreciation is just a borrowed term. It's a tax deduction that the IRS says when you buy a property, whether it's a commercial property or residential property, you can now take the value of that over a 39-year or 27.5-year period. That means that besides for your personal residence, you can literally deduct the entire value of your property. Okay, this is called the depreciation deduction. And it's really important to remember this is not intrinsic to the property. It doesn't matter if the property was built in 1932. You get to start today, the day that you buy the property, and start that 27.5 years. And it doesn't matter that it's already been depreciated by the previous owner. This is your tax deduction relative to you. Okay, so this is really probably the most important part. And I see Johnny put there, your wife is, and that's really important also because either you or your spouse can be a real estate professional. We'll get into that later. But so depreciation says that you can take a tax deduction of your value of your property over 39 years or 27.5 years. And this is including multifamily is categorized as residential for tax purposes. But there's a tax planning technique. It's a tool that allows you to actually depreciate certain components of the property over faster 5, 7, or 15-year periods that allows you to take more tax deductions in the earlier years of ownership. So that's what cost segregation is. And how does this work? First, let's just take an example of what depreciation, what the difference between cost segregation versus normal, what we call straight line depreciation is. Let's say you buy a property for $1 million and we're going to allocate a certain amount for the land. Land does not depreciate. And this is going to vary from property to property based on the location. And that's going to leave you with $850,000 of your depreciable basis, meaning this is the amount that you can take as a tax deduction over that 27.5-year period or 39-year period. So if you buy a multifamily property, that means essentially you're able to take a $30,000, almost $31,000 tax deduction to reduce your taxable income every single year. Okay, so we're talking about income taxes here, guys. This is huge. That means on a $1 million property, let's say you're making $50,000 a year in net operating income, your net profit from the property. That means you're not going to be paying taxes on the $50,000. You're going to first subtract that $30,000, and you're only going to be paying taxes on the remaining $20,000. That's the power of depreciation, and it's simply because you bought this property. Okay, and so real estate, people talk about real estate and the tax benefits that are involved in real estate. This is it. This is the number one biggest tax benefit that is involved in real estate. However, there's something called cost segregation, which is segregating that cost of the property into different categories, allowing you to take depreciation deductions at a faster rate. And essentially, instead of the $30,000 deduction in the first year, you can literally take on many times, $50 or $70 or $80 or $100,000 deduction in the first years or the first 5 years. So we're literally doubling or tripling our tax deduction over the first 5 years. Again, we're front loading those deductions in order to create more cash flow upfront. And I'll break it down shortly so you guys understand everything that I'm talking about here. How this works. So what does it mean before we get into the actual how it works? What's the breakdown here? First of all, I see that Google Slides transposed this a little bit, so we're missing some of the words here from PowerPoint to Google Slides. So, lesson for the future: always use PowerPoint. So how do we do this? It's done by an engineering process of breaking down the property into its components. And it actually used to be called component depreciation, which makes a lot more sense than cost segregation. And so the engineer is identifying all the different components inside and outside the property. The IRS says certain components depreciate on a 5-year schedule and some on a 15-year schedule. And we're able to then put those on a depreciation schedule, allowing you to take those deductions at a faster rate. And I'll show you in the next couple of slides what some of those examples of some of those components in a property are that actually depreciate faster. And so once you do that, you can accelerate this and create more cash flow in upfront. So again, this is a win for Google Slides here. This is really hard to read, but basically what you can see here is 5-year, there are two categories here. We have 15-year property, land improvements, and 5-year personal property or tangible property. What this is we're breaking out stuff from the structure. The structural components of the property is really the only thing that should be depreciated on a 27.5 or 39-year schedule. Now, the structure is always going to be the most valuable part of any property. Okay, we're talking about the doors, the windows, the roof, the walls, the foundation. That is the most value. When you build a property, right, just think about it. The most money going, if anyone's ever done any construction, the most expensive parts are going to be those parts that I just mentioned. And so there's always going to be the majority going into the 27.5 year. But we're going to see shortly, sometimes 20 to 30% of the value of the property can actually be in some of these other components. So what is 5-year personal tangible property? These are things that are non-structural according to the IRS. And this can include, signage, simple things like millwork, mirrors, carpeting, equipment, furniture, appliances, flooring, all that stuff, cabinets, shelving, all the things that are inside of a property that are not considered structural. And so there are many, many things. This is just one example from a multifamily property. And then we move over to the 15-year land improvements. Another big portion of the value in the property can be found in the landscaping and the concrete. If you have paving, if it's a multifamily property and you have a parking lot, the asphalt, all of that has value to it. You have retaining walls, any type of fencing or playground, swimming pool, etc. All of this stuff is considered land improvements and depreciates on a 15-year schedule. And we'll see shortly why this 5 and 15-year schedules, these assets are going to be really important when it comes to the bonus depreciation. So not to be confused by land. Land, we mentioned earlier, does not depreciate, but what's on top of the land does. And so the value of that, you're putting in landscaping, you're putting in concrete. Anyone knows that if you have to repave, an asphalt parking lot, or it costs money. And so that money is considered depreciable over a 15-year period. Essentially, the concept is, that these things need to be replaced at a faster rate than the structure. But again, this is really, if you think about it, it doesn't really make any sense because it's not intrinsic to the property itself. Meaning you can buy a property today and maybe nothing has been replaced for the last, 30 years. And you can now start depreciating it based on your purchase price. And you can now assign a value to all of those components that are in the property, including the parking lot, including the fencing, including the furniture and the carpeting and all that, and say, all of this has a value, and I can now depreciate that value and take the tax deduction of that value over a 5 or 15-year schedule. So again, it's not intrinsic to the real useful life of the property. It's this tax useful life that's really almost like a made up kind of thing based on your specific, subjective purchase price, which again, it's crazy how this works, but that's how it works. So we're learning the rules in the tax code so that we can, apply this. And this is one of the most important, tax rules for real estate investors that is out there. And I think even Johnny or Faye, you put this in the, in the preview of this event, is that this is definitely, and it's true, this is one of the most important, if not the most important tax deduction in the tax code. And you hear this all the time, especially from real estate focused CPAs. This is what they're going to suggest because it's real. So again, we're going to come back to this shortly to show you the real numbers, but just so you have an understanding, remember, every single property breaks into 4 categories. You have land, which doesn't depreciate. You have the structure, which that's on a 27 or 39-year schedule. And then you have these two, 5-year or 15-year. So we're going to come back to this and keep referring to the 5 and 15. The 5-year, that's personal. Just remember personal property, non-structural, and the 15, that's land improvements. So we're going to keep coming back to this, but those are the most essential things you need to learn. And just for your, general knowledge, there are some other categories of 7-year or 10-year properties, but it's very, very few and far between, and not in multifamily properties. You can find those type of assets in like office buildings or other types of commercial properties where you do have the 7 or 10-year schedules. But in multifamily, we're only dealing with 5 and 15 in terms of the cost segregation reallocation. Okay, so just to recap, I know some people have joined since we started, and for those of you who weren't necessarily paying attention from the beginning, And also just because as a teacher, and that's really my background as teaching, we just have to reiterate things over and over and over again until you really understand it, you really get it. You have to hear it from different angles. So conservation, what we're doing is we're not creating new deductions out of thin air. We're taking from this pool of potential deductions that you could take a little bit every single year for 27 and a half years. And we're taking from that pool and pulling forward maybe 20 or 30% of those deductions to the earlier years. What that does is that reduces our tax liability, increases cash flow, and that's what's called the time value of money. So if you guys know what the time value of money is, $1 today is worth more than $1 5 years from now, okay? And that's simple because even without inflation, and we all know what inflation is, we're living through it more so than we ever have in our lifetimes, for most of us at least. I have some gray hairs here, so I'm a little older maybe, but it's incredible how much inflation is causing our value of the dollar to go down. But the time value of money suggests that if you have money now, what you can do with that money to reinvest that and grow that and compound that money over time, it's worth more to have your money now than it is to have that money sometime in the future. Okay, so again, not just because of inflation, but also because of what you can do with your money. So every single accountant that I've ever spoken with who has, who knows anything about real estate, I've spoken to many who don't, so I'm not including those. They say that if the first thing that you want to be able to do when you're looking at taxes is to defer or deduct, okay? Defer or deduct. What can we do to defer our taxes? What can we do to deduct from our taxes? If a CPA is just telling you, oh, you made a lot of money and that's why you're paying so much taxes, you should be very happy about that. Find a new CPA. Seriously, I mean, if that's what their attitude is, I mean, that is true in many cases. But for real estate, you have to make sure that you're taking advantage of these things. A quick question from divert a little bit to Joel here and ask in the chat: can 15-year land improvements be segregated into single-family residences? Yes, of course. Any type of property. Again, conservation applies to any type of property besides for your primary residence. Okay, so if it's a business or investment property of any kind, single family, multifamily, storage, office, retail. We'll get to some of the examples later on, what those actual benefits are, but that's, can be applied to anything. So on average, we're talking about a $200,000 after-tax savings on $1 million of reclassified assets. So what that means in simple language is that, again, we're reducing our tax liability. That doesn't mean you're getting a refund check. Let's say if you get $200,000 of depreciation, it doesn't mean you're going to get a refund check for $200,000 from the IRS. It means that you're going to reduce your tax liability by that amount, and your after-tax benefit, meaning what you would have paid in taxes, that's what the cash benefit is we're talking about. Okay, so who should be doing this? Who can do this? Really, anyone can do a conservation. It doesn't matter if you're individual, doesn't matter if you bought a property in an LLC, it doesn't matter if you bought it under your personal name. Anyone can do conservation. It doesn't matter if it's a corporation. What the only time where it cannot benefit you, or when you shouldn't be doing this, is number one, if you're a nonprofit. So a lot of nonprofits invest in real estate, they cannot benefit from this. Or if you have, a lot of people also invest from their retirement accounts. Anyone know about investing from retirement accounts? If you don't, and Johnny, if you haven't yet, this is a great topic to talk about on one of the future episodes over here, because using your 401k or your IRA and self-directing that into real estate investments is a very powerful tool. Everyone should look into doing that. However, if you do that, it's considered in most cases a tax shelter, which means you're not going to be taxed on that. Therefore, you cannot benefit from the depreciation either. And so that's something really important just to consider if you are, or if you're a syndicator and you're thinking about, bringing on investors who have that, then they're not really going to benefit from the cost seg. So it may be worthwhile either not to do the cost seg or to create some sort of operating agreement that maybe allocates depreciation differently. I've seen that done as well, but contact your own CPA or attorney to make sure that that is done correctly. So again, anyone can be doing this, and we'll talk about shortly where this is not going to be as beneficial. Whoa, this really did not transpose very well from PowerPoint to Google Slides, but I will make it through this because I basically know this by heart. But this is the definition of a real estate professional. I told you guys earlier that this is going to be the most important slide. Little did I know that the slide wouldn't be clear for anyone to even take a screenshot of but you can Google, right, real estate professional status. Something it's referred to as REPS, as an acronym, real estate professional status. But this is taken directly from the IRS publication, I believe 929. Don't hold me to it, but I can get you that information afterwards. Anyways, Google real estate professional status. Essentially, what this says is that if you or your spouse, and that's what Johnny was saying, his wife is a real estate professional, you or your spouse is a full-time spending, full-time, you cannot have a W-2 job. But if you or your spouse are full-time real estate, meaning more than half of your time, but essentially it means you can't have a W-2, and you have to have a minimum of 750 hours a year. So again, it's not enough that you just, are a real estate professional, don't have another job, but also don't work, don't spend any time actually managing, you're just sitting on a beach in, the Bahamas or whatever, that you can't be a real estate professional unless you're actually spending time, 750 hours a year doing this. So what is considered a real estate professional? Either you're developing, redeveloping, constructing, acquiring, converting, right? Renting, operating, managing, or leasing, or brokering real estate. So if you're a real estate broker, you're automatically a real estate professional. If you're doing any of those other things, you're automatically a real estate professional, but you have to own real estate in order to benefit from this real estate professional status. What does that mean? So let's take a pause here on this real estate professional status and take a step back and understand how depreciation works. We've been talking about all night about how powerful this depreciation deduction is. But what we really need to understand is how it applies, because it doesn't apply equally to everyone, right? I know we say like all things are created equal, right? Everyone's created equal. Unfortunately, that's not the case, right? And if anyone's familiar with, George Orwell's Animal Farm, right? It's one of my favorite books over there. It talks about, all animals are created equal, right? But some are more equal than others, right? and that's exactly what this is talking about here, right? All taxpayers are created equal, but some are more equal than others, meaning the real estate professional has a major benefit. And the way that works is like this. Your income is taxed differently. Different types of income are taxed differently. So your W-2 income or your 1099, that's going to be taxed. That's considered active income. And your portfolio, if you have stocks and gains and things like that, that's all going to be considered portfolio income. And then you have this other thing over here that's called passive income. Okay, and passive income, that's called real estate. There are some other things like royalties, or if you invest in a business and you have a passive interest in a business, that can be considered passive as well. But all that's taxed in a different category, meaning they can't blend together. They're not mixed together. You can't take, I get my W-2, I get my real estate, let's put it all together and then, deduct all my deductions from there. No, they are completely separate. Real estate, their rental income, that's considered, remember, passive income. That's where depreciation, these deductions, this cost segregation we're talking about tonight, all goes to offset. So you get, let's say you make $50,000 in income from your real estate, and you have $50,000 of depreciation from your cost segregation. That literally means you wipe out your tax liability, and you pay zero taxes on your rental income. But let's say with a cost segregation study on your $1 million property, instead of a $30,000 deduction like the slide we had at the beginning, you actually have a $200,000 deduction, which is going to be pretty normal if you do a cost segregation study. Now, $200,000 of tax deduction is incredible, but if you only make $50,000 of income, what's going to happen to that extra $150,000? This is simple math, trying to keep it as simple as possible. That extra $150,000 is going to be considered what's called a passive loss. Now, it doesn't mean you actually lose money. You don't. You have that deduction, but it's just sitting there. What can be done with that? Well, if you're not a real estate professional, the only thing that can be done with that passive loss is it carries forward, meaning you can use it next year. You don't lose it. It sits there in like imaginary bank account, and you can use it next year to offset your passive income next year. Or if you have passive gains from capital gains, you can offset that as well. However, you cannot use those passive losses to come over and help reduce your W-2 income. And this is a big, big misnomer. I think a lot of people out there thinking that, cost segregation is awesome, I'm going to not pay any taxes on my W-2. Well, unless you or your spouse are a real estate professional, that's not the case. And now we get to the equality or the non-equality that we're talking about here about the real estate professional. If you or your spouse are a real estate professional, that passive loss, that $150,000, can now come over to your W-2 or your Schedule C income, reduce that, and use those losses against your other income as well. So that's the power of cost segregation, is when you're a real estate professional. Because not only can you offset or reduce your taxable income from real estate to zero, you can actually use that to offset your other income as well. And the most powerful example of this I can think of is one of my clients many years ago, probably 3 or 4 years ago, so not that many, but relatively speaking, 3 or 4 years ago, once bonus depreciation was introduced, and we'll talk about exactly what that means in a second, he was a real estate broker and was one of the top brokers in his county and was making $1 million a year in brokerage, and was paying literally $300,000 to $400,000 a year. He was in California, so high tax rate, and he was paying $300,000 to $400,000 a year in income tax. Crazy, right? He invested in some multifamily properties and was, making some money from that as well, but did conservation, used bonus depreciation. He bought a $4 million property and literally was able to take $1 million bonus depreciation tax deduction. So that year, he went the year before from paying $300,000 to $400,000 to the government. He literally paid zero the next year because he was able to use that, because he was a real estate professional, and use that bonus depreciation to wipe out his entire tax liability. It was life-changing. I mean, that guy is now making sure to buy properties every year to do this over and over, because you want to make sure you get this deduction. Okay, so we'll move off of this slide that we can't really read anymore. There is one exception to this, and this is if your adjusted gross income is less than $100,000, then you can actually take $25,000 of those passive losses to offset your W-2 as well. And this gets phased out up to $150,000, but this is the one exception. Sorry, I should say this is one exception. There's another exception I'd like to touch on in a second, but this is one exception where even if you're not a real estate professional, you can use some of your passive losses to offset your W-2. The second example, which I don't have a slide for, I don't think, no, it's going to go right into bonus depreciation. The second exception is something called short-term rentals, and some people call it the short-term rental loophole. And I think if you guys just Google this, I'm sure you'll come across. I just had interviewed on my podcast today, Tom Castelli from the Real Estate CPA. If you guys don't know them, they have a great podcast as well, and a great YouTube channel called Tax Smart Investors. And learning more about this subject, you can check them out. And they talk about this short-term rental loophole, which allows you, if you have a short-term rental, an Airbnb, and you're renting it out 7 days or less is the average stay, and you materially participate, meaning you're self-managing it, you can, it's not a loophole because it's directly in the tax code, but they call it this because people don't really realize that it's there. It's another exception that you can actually still have a W-2 and use conservation on your short-term rental to offset your W-2 income. So again, special rules there that if the average stay is less than 7 days and you materially participate, you can still have a W. It doesn't need to be a full-time job. You don't need to be a real estate professional, and you can still use conservation to offset your active income as well. Okay, so that's the second exception. Make sure you guys are taking notes here because it's something not a lot of people know about. And make sure to keep those questions coming in the comments here, guys, because great questions thus far. So let's talk about the Tax Cuts and Jobs Act. This was a great tax reform in 2017 that essentially introduced something called bonus depreciation. The phase out we're going to talk about right now. But what this said was that you can now take 100% of any asset that is on a faster depreciation schedule. So you remember, if you go back to the slides of the 5-year and 15-year, guys remember 5 and 15? 5-year, 15-year, if all of these things are going to be allocated to these faster rates, you can now take them instead of over a 5 or 15-year schedule, which is still great. You have now the option to take 100% of those deductions in the first year. Okay, that's called 100% bonus depreciation. That is what has been happening since 2018. The end of 2017 has allowed people to take 100% of those deductions in the first year. Now, January 1st, 2023, just a couple of days ago, we have now entered into the phase out period, which means it's going to now be reduced by 20% each year, which means now this year, 2023, it's going to be 80% bonus depreciation, which means any of those deductions, you can take the accelerated amounts, 80% of those in the first year, the remaining 20% can still be spread over that 5 and 15-year schedule. So it's still great, but a little bit less beneficial. And this is going to start continue to phase out by 20% each year until it's totally out. I'm going to skip this slide because this is no longer applicable. This was something for the 2020 and 2021 tax years. So I'm just going to move right along to when is the best time to do this? Anyone have any ideas when the best time to do cost segregation is? The answer is, it's a trick question, because the answer is you can do this anytime. There's not really a best time. It really depends on your situation when you can most benefit from these tax deductions. And that's the great thing. It doesn't need to be done in the first year of ownership. Most people like to get it done right away, right after acquisition. Get it done because you want to set up your tax deductions right, the right way from the beginning. However, it doesn't need to be done. It actually be done on properties you owned in a previous year. Let's say you've already filed taxes on them for a year or 2 or 5 years. You can do what's called a look back study. That means we can catch up whatever depreciation was missed that you could have taken. And so again, this can be done immediately and the look back study going back, but it can also be done on a new construction property or on a renovation. If you remember from the beginning of the presentation, we said that your depreciation basis is based on your purchase price, meaning the amount you can totally deduct is based on your purchase price. That doesn't change if you get an appraisal, if it goes up in value. That does not change how much you can depreciate. The only time it's going to change is if you add more money into the property. So if you do renovations, you add more money into the property, those capital improvements can be depreciated, and you can actually break it down into its different categories to make sure you're doing cost segregation, getting those accelerated deductions of some of those components. Because if you're, just replacing some drywall or replacing the roof, that's structural, not going to benefit so much. But if you're replacing the parking lot or you're replacing furniture or doing the kitchens or cabinets, all that stuff can be depreciated faster. You can take those deductions as bonus depreciation and get those at faster rates. So definitely worthwhile to check it out and look into it. People often ask, what price amount or what price point does it make most sense to do the cost segregation on? And the answer to that is, again, it really is going to depend on your situation if you need the tax deductions. But I'm seeing properties even over a $200,000 purchase price, it's going to be definitely worthwhile to look into. So keep that in mind. People often think, oh, it's only worth it if it's $5-10 million property. I don't know where people are getting those numbers from. The numbers make sense for themselves. And now we're going to jump into the case study and you'll see exactly what that means. So CapEx items in general, yes, CapEx items in general, any amount you're putting in, unless it's just maintenance stuff, if it's CapEx, it can and should be depreciated. And many of those items can be depreciated at a faster rate and get those tax deductions in the first year. So here are some examples of different types of properties and what the amounts that can be depreciated faster. So you have, again, Google Slides did not do a great job here of transposing this, but you can see here apartments, this should be about 25%. I don't know why this is off. Okay, so this is totally off here. I don't know what's going on here today, but apartments, typically multifamily is about 25 to 30%. It should be about 28% here, right in the middle, if I remember correctly. Retail, about that. Hotels, manufacturing facilities, around 30 to 35%. You can see there's a gap here between the 25 and 35. And, all other types of properties are great. Warehouses on the lower end, about 15 to 20%. And then mobile home parks, that's this one that's really off the charts, because the majority of mobile home park is just going to be those land improvements, the landscaping, the pavement, the concrete pads. And that's pretty much all you own besides for the land. And even the houses that you may own, those mobile homes, if they're truly mobile, then they're, and you own them as the mobile home park owner, you can actually depreciate them on a 5-year schedule in many cases. So again, many great benefits to the mobile home parks. And all types of properties can benefit from cost segregation. So now let's jump into the case study here. Okay, so this is a 32-unit property in North Carolina. Again, this is a couple years ago, because I don't know if you can find a 1.75 million. I don't know, Johnny, what your experience is for it, but that's probably like a duplex where I come from. But yeah, a 32-unit property. Without cost segregation, the total depreciation would have been about $54,000. Okay, and the reason why I'm pointing out here, this is his first multifamily after many single family, and we'll see shortly the reason behind this story. But without cost segregation, he would have had a $54,000 regular straight line depreciation deduction, which is great, because if you have a 1.75 million property, you're probably making net operating income about $120,000 if it's a good property. That means that he was, reducing that and only paying taxes on about $70,000 or so. So still great. not the best. But what do? You do a cost segregation. Here's how it broke down. And this is pretty average for multifamily properties. Again, we're taking off about 15% for land, which is pretty average. And then the remaining amount, the majority, 72%, over $1 million of this property is going into the 27.5 year, the structural components. But the 15-year, the landscaping, the pavement, the concrete, fencing, all that is about 8% of the total value going in. That's about $122,000. The 5-year property, again, this is all the interior non-structural items like appliances, furniture, cabinets, countertops, carpeting, flooring, all that kind of stuff, almost $300,000. Okay, so we're talking about 28% total of the value of the property going into the faster depreciation categories. Adding that up, it equals over $421,000. So think about this. Instead of a $54,000 tax deduction, in the first year, he was able to take a $421,000 tax deduction. So what would you rather have, $54,000 or $421,000? Yeah, I think it's pretty clear. Now, you may ask, well, it's not all just, free money, right? We're going to have to pay it back someday. Well, that's actually not entirely true either. But I just want you to understand this for a second. When we talk about front loading these deductions, what that means is we're pulling from the deductions that we could have taken at a later time. So what does that mean for, next year, year 2, or year 3, 4, 5? If I'm holding this property for a few years, I want to make sure to get depreciation then also, right? Well, yeah, you're still going to have 72%, right? That's $1 million. Over $1 million. That means you're still going to be getting about a $40,000 deduction every single year, close to $40,000. So instead of the $54,000 every year, you're getting first year a huge lump sum, and then $40,000 every subsequent year. So again, you're not just losing out and getting no deductions in the subsequent years. Also, any of these deductions will carry forward, meaning if you can't use them all up this year, you can use them in the future years. Now, the reason why I mentioned that this person had a multifamily property, bought this multifamily after many single families, was because he tried to do what's called a 1031 exchange. Now, I don't know if you talked about that yet on the show here, Johnny, but it's a really important tax strategy that allows you to defer your capital gains tax. Well, there's some rules that go into it. You have to do it within 45 days. You have to identify properties. You have to close it within 180 days. And you have to make sure it's all the paperwork is filed correctly. And if you don't do all that, you don't find the replacement property, you can't make that exchange, that trade from one property to another. And you basically lose out. You end up having to pay the capital gain tax on the sale. Not so bad. You make money. Everyone understands you make money. You have to pay some tax on that. But he wanted to find another way. And that's exactly where cost segregation came in, because not only did he use this cost segregation to offset his $120,000 of income, he used the extra $300,000 loss to offset his capital gain tax and paid zero capital gain tax as well. And so that was a huge strategy that a lot of people don't know about, is that we like to call this the lazy 1031 exchange, where you don't actually do a 1031 exchange, but you're still able in the same year, if you make a sale and do cost segregation in the same year, you can use that against your capital gain tax. So this is a really powerful strategy. And just to kind of reiterate what we talked about, the recapture tax, what happens on the sale. I think I have a slide for that here, but the recapture tax means that when you sell a property, you're also taxed on a capital gain called recapture tax, which means any amount of depreciation you took, you're able to, is that me? Am I freezing up? No. Okay. So any amount of depreciation you took during the life of ownership, you are now going to be taxed on that amount on the sale, subject to that tax as an unrealized gain. So similar to capital gain, it can be deferred with a 1031 exchange, or it can be reduced with other depreciation or other losses from another property in the year of that sale. So by saying that, by taking this depreciation, you just have to pay it back, is totally wrong, number one. And number two, not only do you not have to pay it back, you may never even be taxed on that amount, because using the right strategies in place, you can actually reduce that tax at the time of sale as well. So just what actually goes into this? Now, we talked a little bit on a very, very high level. There's an engineering component. Engineer goes to the property, takes pictures, measurements, and we're doing a lot of these virtually at this point, which means you're still seeing the property, but not having to actually physically go to the property. This is all in line with what's called the Cost Segregation Audit Techniques Guide. So if you guys want to check that out, it's on the IRS's website. this is what's called a quality cost segregation study. It, expertise and experience, there's a whole methodology, there's a whole numbering system. And if you see what, goes into this very detailed report, that there's calculations, there's all the explanations, the identification of the tax code, and there's all court cases listed, et cetera. The IRS requires the work to be shown. Essentially, you can't just say, oh, I bought a property. Yonah said I can take, 25% or so of the depreciation in the first year. I'm just going to do that. Forget the cost seg study. I'll just do that. So that's like, on your test or something, just putting the answer there using the calculator, but not actually showing the work. So the IRS requires you to show the work, and that's what the cost segregation study and the engineering report actually covers. So that's really pretty much it. I mean, that covers the basic levels of everything you ever wanted to know about cost segregation. I know I talk a little bit fast, so please, if you do have any questions, now's going to be the time. If you do have any other questions and I haven't answered them tonight, or we don't have a chance to get them, or you remember after we hang up from the call and you're like, hey, where's that Yonah guy? Make sure to find me on LinkedIn. I'm very active on all the social platforms, most recently Twitter, but LinkedIn is where I'm most active. So make sure to connect with me there. Don't just follow, but actually find the connect button and send me a message. Or you can find me at yonahweiss.com. Oh, that's my email and phone number. Yeah, it looks like Reginald had a question there. Do you want to turn your mic on?
Yes, sir. How you doing?
I'm doing great.
Hey, so first of all, I want to say you did a phenomenal job. I've heard of cost segregation and kind of had like a little bit of an idea of it, but you broke that thing down like you was breaking down a Rubik's Cube. So I really appreciate that. The question I had two questions. Well, you already answered one about LinkedIn. I just followed you on Instagram.
Oh, great.
My next question is, what makes a great CPA? Yes, sir. What makes a great CPA for a real estate professional? What would be some of the criteria that we should look for?
Well, first off, you want to ask them if they have experience with cost segregation. I mean, that's a simple one, because that's something that if they don't, then that's a big red flag right there. But cost segregation is one of those things that kind of differentiates a CPA who's just kind of a general practitioner from someone who's more focused on real estate. And they don't have to necessarily be doing the cost segregation, because CPAs can't really do this. It's something more for, they know about it. They have the right partners. They have the right cost segregation companies that are going to be able to do it, but they actually know what it is and can apply it. It looks like we lost Reginald.
No, I appreciate it. No, I heard that. Thank you for your help.
All right, who else we got?
Joel?
Johnny, why don't you, I love Johnny. Can you chime in a little bit? Because you're the only one here that I know prior to this call, and one that I know that you have some actually firsthand experience with using cost segregation. I mean, would you mind sharing, if you wouldn't mind, a little transparent, just how that's actually been able to, what it meant to you by getting something like this done, and how you've actually been able to save taxes on it?
No, most definitely. I'm gonna get Joel to ask his question, then I'll definitely share my kind of case study.
All right, perfect. Joel, yeah, let's hear it.
Thank you for a wonderful presentation. It was very eye-opening. Is there a standard rate that people that do cost segregation charge? How do we know if we're getting a good price? Does it vary based on the asset or what?
Excellent question. Yeah, I mean, there are dozens of cost segregation companies around the country. I think there is probably a wide range of what costs are. There's also a wide range of the quality of the types of studies that are being done. But the highest form, I think, it is, yes, going to depend on the size and the type of the property, most on the scope of work. So it's never going to be based on contingency on how much tax savings you're getting, like a percentage of your tax savings. That's actually not legal to do that. So if someone is trying to charge you that, run the other way. But typically for single families, I can tell you what our company, Madison Specs, the biggest national company that does this. I can tell you single families, we charge about $3,000 for single families to do this, and then going up multifamilies is, somewhere between $5,000 to $6,000, and other commercial properties somewhere in that range as well.
Thank you.
No, great question. Yeah. So with my personal experience, we actually used Madison Specs, used Yonah's company for our 18 unit that we purchased back in 2020, which was during the realm of which was after the Tax Act from 2017, which allowed the bonus depreciation. So for numbers, our purchase price was $1,050,000, and we chose to have the cost segregation the first year that we put the property into. That we bought it the first year that we took ownership and started buying the property, even though we did know that there was going to be a CapEx. We added probably about another $70,000 of renovation over the next 18 months. But with that, we had $1,050,000 purchase price. Our bonus depreciation, our first year deduction was right at $178,000 for the first year depreciation. And I think we were right at $30,000 each year after that, going forward. So it was definitely a benefit for that asset. And if you look at it, our down payment to purchase that property was only $210,000. So if you look at it, we put in $210,000 in the first year. We were almost able to wipe out all of that, close to about 90% of a little bit less than 90%. Of the capital that we had to actually purchase the building, just like that strategy that you said, Yonah, where is that you have a tax event the same year, you choose to buy a multifamily where you can do a cost segregation that essentially instead of doing a 1031, you can actually wipe out the taxes associated with that income. So it's definitely a great tool, one that we're looking at right now with getting a cost segregation study done before the end of the tax period for 2022. Going now with this one with the apartments that we picked up last year. And and that was the mad dash to try to get that 100% bonus depreciation before 22 closes out, just to make sure that you get 100% bonus that would not leave that money on the table. Whereas that now we have the remaining 20 unit that we're about to close on in a couple of weeks that'll fall off into the 80% bucket now, which is okay, which is fine.
Yeah, I mean, still great, but you're absolutely right. And there's still time to get it done for the 2022 tax season. As long as you get it done before your tax filing, you're able to, to use the 100% bonus.
Okay, that's really good news.
Yeah.
What are some of the things that are required with doing the cost seg? Like, what are some of the paperwork that the owner needs to have?
So not really a lot. I mean, if you're just doing an acquisition, then what we would look at is just the purchase contract. So your closing statement, if you had an appraisal done, we're going to look at that as well. But if you are doing, CapEx, you're doing improvements, we would need to see like a scope of work and kind of a breakdown of the cost of that as well.
Awesome.
Hi, Yonah, I have a question. This is Sassy.
Fantastic.
So hi. So thank you for this information. I was about to attempt to take notes, but you were talking pretty fast. So I was like, you know what, let me just not take notes and I'm just going to listen as much as I can. Of course, no one's going to understand all of this in one sitting. But one of the things I just wanted to make sure I heard you correctly that you said earlier. So when you first acquire a multifamily property, is a person, or should they do a cost segregation study right after acquiring the property?
So yeah, it can, like I said, it can be done on, doesn't have to be right after acquiring the property, but there is actually one caveat there. So I will mention it can be done at any point. So if you want to get done in the first year, I mean, before your taxes for the first year of ownership, it just has to be done sometime before you file taxes for that. But the caveat is really if you're planning on doing renovations in the property, anytime in the interim between buying it and placing it in service, or anytime between buying it and maybe filing taxes, you can actually do the cost seg in 2 stages, which is where you can do the cost seg on the acquisition, break down the purchase price into those different categories or components, and then take those deductions. And then once you've done the renovations, you can kind of follow up and add those assets to it and take those deductions as well.
Okay.
Does that make sense?
Yeah, that does. Okay, so you said you could do it in 2 stages. Okay, so I had another question. Something that Johnny mentioned earlier, he said, and I think I heard him correctly, he said that, his down payment. Now, when they purchased or acquired that property, does doing a cost segregation help to increase your internal rate of return or your return on your investment? Does that exponentially help with that?
It certainly will. And I think that's a really interesting kind of factor to add into the underwriting is what is, because most underwriting is going to be looking at, before taxes. But on an after tax basis, your cash flow is actually going to be increasing, which is going to hopefully add more to your internal rate of return.
Okay, wow. Okay, that's interesting. And your company, Madison Specs, this is what you guys do. This is all you, not all you do, but this is a big part of what you do.
Yeah, this is the main thing that we do. We
Okay.
have a few other commercial real estate services like 1031 exchange, qualified intermediary, and title insurance for commercial across the country. But the Specs organization is mainly focused on the cost seg.
Okay, that's good to know. Thank you.
Sure, happy to help.
Oh, all great questions. Any other hands? I got a question. Yonah, what do
Sure.
you think, kind of from your standpoint? I know you said you've been doing this 5-6 years now, for that time frame. What have you seen any like unique situations with properties that were kind of out of the norm, or is there's some that kind of something to look out for that may be like unique, whereas that may not be a large that could reduce the benefit of a cost segregation?
Certainly. I mean, we've seen every type of property under the sun. It's pretty incredible when you look at it. But one thing that people a lot of don't think about a lot is when you're doing a gut renovation. And I just mentioned Sassy earlier. You can do in 2 stages when you're doing a cost segregation study. But if you're just gut renovating a property, this is something a lot of people don't realize is that you really miss out on the cost segregation on the acquisition if you're totally gutting a property after acquisition before placing it in service, because you've lost out all those components that you could have depreciated faster. You're essentially saying, I'm not using those. And if you're not using them as a rental, you can't depreciate them because again, depreciation is only for a rental property. So that's one case where it's kind of really low on the end. One type of property that's really on the high end spectrum, which is pretty awesome, has been mobile home parks, as I mentioned before, but RV parks as well. They're kind of been a little bit more popular in the past couple of years. In fact, I've invested passively in a couple RV parks. It's just incredible the returns. We talked about 20, 25% in your case, maybe 20% of the tax basis. RV parks, we're talking about like 70 or 80% of the tax basis, going to the bonus depreciation. Because again, all you have is like just the land, concrete, pavement, landscaping, fencing, et cetera, all those land improvements. So that's really something that's pretty fascinating. Another really incredible thing that I found, which is with Airbnb properties, because of all the amenities and kind of luxury type of appliances and equipment, et cetera, it can be much more than a multifamily or a residential type of property would normally be on. So that's something pretty incredible to look into, especially combining that with the fact that Airbnbs typically have higher cash flow, so you're getting more revenue, and 2, that the loophole that I was talking about, or the strategy with the short-term rentals and being able to use them, those deductions against your W-2, it's a great combination.
Yeah, it definitely adds fuel to the fire, and it kind of it takes the benefits of real estate investing that you look at when we traditionally think about just a single family rental. Now you start looking at multifamily, just all the additional benefits that, it's almost a non-comparison. But I love the RV parks. I didn't think about that with just all the additions to the land and able to the bonus depreciate and accelerate that.
It's pretty wild.
Yonah, I got another question. This is Sassy.
Sure.
can someone, I know you've been talking from the aspect of investment properties. How can a person do this in their regular residential property that is this possible in a primary residence?
So unfortunately not. This is only
Wow.
going to be, this is a deduction only for rental or investment properties.
Gotcha.
Yeah, so it's not going to be at all for your primary residence.
Okay. I just thought I'd ask. I was just curious. So there's no way that a person could depreciate anything like with if you do any major stuff to your house. There's no way tax wise that someone could do that.
No, unfortunately not. I mean, there are certain things in terms of like if you have a home office, you know,
Mhm.
or if you're renting out a room in your house, you know, a kind of prorated amount of the space, you know, can
Right.
be maybe depreciated, but yeah, besides that, not.
Okay. Oh, I just thought I'd ask. Thank you.
No problem.
Yonah, how would that work if they moved out and they put it into service as a rental?
Yeah, excellent question. So that's obviously, I mean, it's pretty common. I've met many, many, many people that are accidental landlords, right? They call it, you know, you buy a house and then you move out, and instead of selling it, you end up renting it. So at that point, once you put it into service, it becomes a rental property. So it's going to be your depreciation basis is going to go back to your original purchase price. So it's not going to be based on like the market value. However, your depreciation is going to begin at that point. So once you do start renting it out, you can then start claiming depreciation on it.
Okay. Thank you. Okay, Faith.
I have a question for you. Yeah. So what about if
Yes.
you're house hacking?
Yeah. So house hacking, right? Where maybe you're living in a multifamily property, living in one unit and renting out the others. So again, going back to that kind of prorated amount. If you buy, let's say, a duplex, keep it pretty simple. Buy it for, you know, $300,000, let's say. Half of the amount, if it's equal, let's say it's equal, you know, sized units, half the amount is going to be your personal residence. You cannot depreciate that. The other half is going to be your rental property. And so you can depreciate that amount.
So if say I'm using FHA and I'm actually going to be required to be in the property for the first year, right?
Right.
And then the following year, say I have both units rented out. Can I do cost seg during the first year, or is it best to actually do it the following year?
So, I mean, you can really do it either, or it really depends on how much you need the deductions. What would happen in the next year, like in your example, where you're renting it out and you're only living in half the space, renting half the space, you're only going to half the depreciation amount. What happens when you move out and now you have the whole property? Now the whole thing is a depreciation. So now you're going to basically have the whole amount to depreciate, but the second half is going to be on a different schedule. And so you're going to have what's called a step up in basis. And so you have to file a special form in that regard. That's going to change your depreciation basis. It's basically a step up in basis because again, you're going from like half the amount to the full amount. So either you can depreciate it, you know, the small amount at that point in the first year, or you can, you know, just wait until do it when it's a full rental property and just depreciate it and do the conservation at that point. So either or, but either way, you're still going to have to do that step up in basis form.
Nice.
A similar yet, you know,
Wow.
somewhat different comparison I just had recently, where you have someone, they have a partnership and you end up buying out your partner or buying out investors. It's a fairly common thing in, and so same thing would hold true. You'd have to have a step up in basis in that point where, you know, you actually own more shares or own more of the property now that the investors have left or the partners left. And so now you're going to have more to depreciate.
So Yonah, a good real estate CPA should know all of this which you're going over, correct? Or somewhat similar?
I would hope so.
All right. Okay. And the real estate, so the earlier you mentioned the real estate, they have a podcast. What is that? The real estate CPA? I've heard of them before too.
Yeah, they're great. Real estate
Right.
CPA, Brandon Hall, Tom Castelli. You know, I can, if you want, I can find it over here. I'm subscribed, so give me a half a second. I can actually just find it and put in the chat over here. They have a ton of great content just surrounding real estate, and they have a great, really active Facebook group also just about taxes and real estate. So
Okay.
highly recommend it if anyone, if that's something you're interested in.
Okay.
There's
That's
put
awesome.
in the
So
comments over here.
are they a pretty good, because they're CPAs as well. I think I've been on their website a while ago, but are they, do you think they would be, I know you can't necessarily recommend per se, but do you think they're pretty good at what they do to be able to provide services to an investor?
You know, in terms of tax filing, in terms of tax advice, yeah, I mean, they're pretty good. I would say that from what I've heard from some of my clients who have used them, they're a little more on the expensive side. They
Okay.
focus a lot on advisory, and they have a lot of kind of courses just to help educate people. And so they, again, a little bit more on the expensive side in terms of tax filing in comparison to others, but yeah, they're definitely competent.
Okay. Thank you.
But yeah, just again, tons of great content, all about taxes and real estate. So if anyone wants to learn more, I put the link to their YouTube in the chat there.
Awesome. Well, Yonah, we're 5 minutes over. I want to be respectful of your time. I truly appreciate you coming through and just educating us all on cost segregation studies. And I think just from the engagement and the questions, I think everybody definitely learned a lot. I've learned some new things too, which is just awesome. Would you like to definitely, before you go, just share your contact information for anybody may want to reach out? Because I know we got some individuals in the room that's looking to pick up multifamily this year and start and get into some apartment deals. So I think you definitely want to reach out to Yonah and the Madison group.
Yeah, I know a few guys I see followed me already on some of the socials. I put my link there. You guys can actually, instead of copying that, you can, if you go to the bottom of the chat box, there's 3 dots. You click those 3 dots and hit save chat, and you can actually just save the chat. It will turn into a document over there, so you can save all the notes and stuff as well as the links there. But yeah, you can find everything you want from me right there in the link tree.
Awesome. But make sure you subscribe to his podcast.
Please do. Weiss Advice. We had Johnny on as a guest. It was great.
Well, awesome. Well, I just want to say thank you again, Yonah, and yeah, great seeing you. And I'll be in touch too about our cost seg too.
All right, sounds good. Have a great night, everyone. It's a pleasure meeting you all, and look forward to hearing from you again.
Thank you, Yonah.
Thanks, Yonah.
All right. Thanks, Yonah. Thanks, everyone.